91% of Canadian retail investors fail. And in this video, I'll share with you 4 main common mistakes that I see out there, how you can avoid them, as well as what I'm doing with my portfolio, investing in this market and its progress. If you guys are new here, my name is Daniel, and here on this channel, we talk about Canadian stock market investing. So if that's something that interests you, consider subscribing down below. The first mistake that retail investors make is following the crowd. And obviously, the answer to not making this mistake is to not always follow the crowd. Now, the key there is not always, because most of the time when you're following the crowd, meaning all the other retail investors, then you got to think about for yourself. If everyone and their dog already owns a stock, then who else is going to be buying at these higher prices? All the people who are talking about the stock right now, they probably bought in at lower prices, and of course, they're going to have a bias as to why this company is a really hot stock, because they have a vested interest in this. So when you're buying into a stock that everyone and their dog is talking about, you must think critically for yourself, am I paying a good price for this company? Or is everyone who's in this stock already at a lower price and hoping to sell for a quick short-term profit? Usually stocks that are in with the crowds are these momentum stocks, and they are riding on a hype train. So make sure you don't get caught when the train is crashing. The second mistake is investors are buying high and selling low. Usually when people buy into a stock, it's because their friend or someone else talks about the stock, and it might be also a stock that the crowd is in. And investors will buy high, hoping that it goes higher, and maybe it does for a short period of time. However, when the stock comes back down, the investor's like, oh, maybe it'll go back up. And it keeps dipping and dipping and dipping. And at some point, something gets triggered in the mind, and they're like, I just got to get out of this, cut my losses, and just stop investing. And that's the exact moment where the stock usually starts to go back up. And the sad reality of all this is people bought in because of the hype, and when they saw the hype was over, they decided to get off the train at a loss and maybe just completely quit investing overall. And that's why in 2020 and 2021, when the bull market was happening, there were a lot of retail investors who were interested and started trading for the first time. However, it's very evident right now that a lot of these new investors have already dropped off. So in order not to fall into this buy high, sell low trap, maybe you should consider thinking like a contrarian. Usually thinking like a contrarian in the market is a good thing. Obviously, don't just buy a stock because it's going down, but if it's going down, maybe consider looking into the company, seeing if there's anything there for you to invest in, and taking a position in it. As a great investor, Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy. The third reason why retail investors fail is because they have too much money in one position. So when you have too much money in one position, this really makes your emotions swing. For example, if you were in the shoes of an investor who invested at GameStop at $3.20 and saw the stock drop to $1.60 in the span of weeks, how would this impact your mental health? Would you be able to sleep? Would you be able to even enjoy TV? Or would you always be checking your stock market portfolio as long as the markets are open, hoping that GameStop would go back to $3.20 and even beyond that? Now, obviously, this isn't me telling you that you should never invest in some of these hype stocks. However, you should size your positions correctly. Make sure you don't put too much money into these hype stocks that it impacts your everyday well-being as well as your mental health. Not only does this actually affect your mental health, it'll also cause you to do dumb things in the market as well. For example, maybe you bought into the GME hype and then all of a sudden you saw AMC skyrocket and you got in at the peak of that because you're like, oh, if GME is down, maybe I can make money on AMC, and AMC's already gone up by 300%, maybe it'll go up by even more than that. Well, if you took that approach, then you probably lost even more money. So sizing your positions correctly and making sure that you don't lose sleep over your money is the key thing to staying invested in the market. Because if you get trapped into this and you lose a lot of money, this is how a lot of investors actually quit investing in the market. It's because of these negative experiences, and then they also go tell their friends that the stock market is like a casino. And obviously, if you're doing that strategy, it basically is a casino. But most people who size their positions correctly, they don't buy into the hype and they don't buy high and sell low, they're still in the market. Now, the last mistake that retail investors make is that they don't do their research. There are some people out there who argue that research is useless, and sometimes great companies that seem like a good business still have their stock price go down, because oftentimes stock prices are disconnected with business performance. However, if you do your research into stocks, then one main thing is going to happen. It's the fact that you won't sell at any sign of danger. Because if you've done your research, you know the company, and you have a strong conviction, then you're able to hold through those tough times and maybe even buy more and average down in your position rather than panic selling and leaving the market altogether. And if you think research is boring and keeping up with the market is a drag, then you should check out today's sponsor, The Peak. The Peak is a fun and enjoyable newsletter to read, and it only takes about 5 minutes of your time. I've been enjoying The Peak over the past weeks, and I've been able to stay up to date on what's going on in the market. It talks about everything from the stock market to crypto to even vaccine rates. It's entertaining, quick to read, as well as they get right to the point and they don't waste your time. The Peak is basically like the Morning Brew, but for Canadians. And if you guys have been subscribed to the Morning Brew, you know that it's always free. In The Peak, they're doing the same thing. It's going to be free no matter what. So if you guys are interested in The Peak, you can check out the link in the description down below, and you can start reading The Peak as early as today when you sign up. Now that we've gone over the 4 reasons as to why 91% of retail investors in Canada fail, let's go over my portfolio and see what's been going on. In this portfolio, I've been investing for 22 weeks so far, and obviously that's not very long. However, I have other portfolios that have been in the market for 5 years. So as you can see, the portfolio percentage change since I started is 4.93%. So we're actually up a fair decent amount in the green now. And if I compare that against the TSX index, unfortunately, I still am down by 1.46%. But I am a long-term investor, and I don't really look at how I'm down against the TSX and get discouraged. 1.46% is how much the market could move in one single week. So next week, I could be up against the TSX index, and that's very possible. Jumping over to what I bought this past week. I made 5 different transactions, and I bought a new stock. As you can see here, Shopify. So on August 10th, I bought some DCM at $1.30. Then I bought a couple shares of TELUS at $28.36. Then I averaged down on DCM after their earnings, and unfortunately, investors didn't really like their earnings and dropped the price to about $1.18. I bought 3 shares of RioCan for $22. And on Friday, I made my first fractional share purchase of Shopify, and I bought 0.0267th of a share. Jumping over to my portfolio, you can see that I have diversified my portfolio fairly well. I don't just own 2 or 3 stocks. I own about 18 stocks in this portfolio right now. I'm not invested just in one sector, so I've diversified that over multiple sectors, as well as the risk levels. I've diversified over different risk levels from low risk to medium to high risk. Some of these companies are unprofitable right now, some of them are making a good profit, and some of them pay dividends while others don't. So when I'm investing in this portfolio, I never lose sleep overnight if one stock is down like 14%. I've actually got 2 stocks that are down close to 15%. Good Nature Products as well as Data Communications Management Corp. And you can see over to the right that these stocks are actually listed as a medium as well as a high risk. But scrolling back over, you can see that there are also other stocks that I'm up 17% on, 25% on, 12% on, and 11% on. So what I tend to do is when I see laggards in my portfolio, I end up averaging down on those stocks. And the stocks that I'm up on quite a bit, I tend to be a bit more critical and slightly reluctant to add to them. However, if the business case does present it, like if they had amazing earnings or they had some huge growth catalysts that came to fruition, then I would have to readjust their valuation and possibly average up. Another thing that I'm doing in this portfolio is dollar cost averaging every single week. So every single week, I'm depositing $200. You can see that I deposited here $200, $200, $200 here, another $200 here, and it's every single week and just being very consistent. That way, I don't just deposit a huge lump sum, decide to go crazy in the market, watch my portfolio crash and burn, and then leave the market all scared because the portfolio just went to zero. By doing this dollar cost averaging and depositing every single week, I make sure that I capture the lows as well as some of the highs. However, the long-term outlook for this portfolio and for the market is that it's going to go up. Sure, I may be buying at high points right now. However, I'll also be buying at low points if those crashes do come. And through this disciplined investing, this is how retail investors can build wealth over time. So don't be like one of those retail investors who buy into the hype and sell into the crash. Be disciplined, be smart, and invest consistently into the market. If you haven't started investing today, you can check out Wealthsimple, which is completely free, and you can get $25 for signing up. On top of that, if you sign up for the Cash App, you can get an additional $25 on the Cash App as well. Links are in the description down below. And if you want, there's 2 videos I'll throw up on the screen. You can check them out. If you're there, I'll see you there. If not, keep up with the grind and have a great day.